Before we get to our virtual hedge fund stocks to buy, stocks to watch, we're going to talk about where we are in the market cycle. 8 out of 10 stocks follow the market. Our job every day is to get on the right side of probability when rewards worth risk. That's our job. So today, this discussion is titled Raising Some Cash. I understand that's a strange title after yesterday's title, which was Party Like It's 1999. And yet those two thoughts go hand in hand in the market we're in right now. Big picture, 1999 type action, we could have a window from here to March to continue to make money in this market. Drill down into where we are in the cycle, 30 days into a risk monitor green signal, building a cash balance to take advantage of weakness. Grab a pen, piece of paper. You're a portfolio manager on a hedge fund desk. That's the way you got to think. If I had to pick one fact that separates the hedge fund manager, the institution, the professional money manager from an individual investor, it's that the professionals focus on managing risk first and then capturing upside. The individual never thinks about managing risk and plunges into the market and chases momentum. And that's what we're changing here on this desk, right? I ran hedge funds for a decade, been managing money for 35 plus years. So I'm sharing this with you. I mean, I've worked with, I don't know how many, thousands of investors. I mean, I got a huge body of evidence. So when I say that this is the biggest weakness of the individual investor, I know what I'm talking about. And I literally started the ARMR report to help with this issue. I called it ARMR, stands for Algorithmic Risk Management Research, so that we always start by managing risk. And then we could talk about all the fun when it comes to what stocks to buy and how much we think they can go up. We could talk about that second. But always come to my desk, always come to my morning meeting, thinking to yourself, how am I going to manage my risk today? How far out in a limb am I on risk? And is that correct for where we are in the market cycle? So when I'm done talking, you're done listening, I want you to think for yourself. What's your risk tolerance? I'm not telling you how much risk to take. I don't know you. You might look at your portfolio and say, yeah, I like this risk. I can handle it. Great. But I want you to think about it. As we get to the end of another strong week for our portfolio, we're going into the weekend. Make sure you're positioned correctly. But you're looking at SPY. And what I want to point out are these 2 days right here. Okay, that day and yesterday. Okay, these 2 days, and I should probably change their color to yellow because these are danger days. Oops. Oh, that was a real danger day. Apparently, I made it magenta. All right. Those 2 days are what I call ARMR distribution days. And you hear me, the term I use is 100% down day. It's very rare, particularly in an uptrend, for us to put carry trades on, right? We have a carry trading portfolio. We have 3 portfolios at our hedge fund: carry trading, swing trading, investing. Carry trading, all I do, I hold treasury bills in that portfolio, so it collects interest every day. If you're doing this with me, you have to own treasury bills. You can't use money market fund. Money market fund, brokerage firm won't give you the interest, because if you're trading every day, they only give you interest on assets that have been sitting in the portfolio for more than a day without trading, okay? So they steal your money if you're day trading. They steal your interest, okay? If you buy treasury bills, you're going to collect the interest, and the brokerage firm lets you borrow against that. at 100%. So you could trade all day. And if you give the brokerage firm their margin back by the end of the day, you don't pay interest on it. So you're stealing from them. So get on the right side of that trade, okay? So we hold treasury bills and we buy the S&P. These 2 yellow days I want to show you here, in a risk monitor green uptrend, it's very rare you get 100% down days. And what that means to me is every entry point we get, we can't make any money on. It don't go anywhere. That's a distribution day. Now, the traditional distribution day, we can go look at that, is the William O'Neill style of distribution day is looking at volume. So you're going to see down here, there's no real volume, okay? There's no volume. The bottom right-hand part of the screen, I don't know if you can see that. Can you see that right down in here? Okay? There's no real volume, so nothing's really happened. But if I could, I can't do it, but if I could zoom in here, you would see that the last 3 red volume bars are bigger than the blue volume bars, even though all of the volume in the last couple of weeks is below average. So the volume's below average, so not a lot's going on. But 3 of the 6 days, the bigger volume days, are down days. Okay. So you're getting a little bit more volume on the selling days. And then when we drill down into what we do, what we call 100% down days, that's the first sign of institutional distribution. Now, you can have a couple of distribution days, then the market screams higher. That's great. That's the market self-correcting during the week. And then it has a strong close on Friday. And that's very healthy. So there's nothing wrong with it. But it's also the first sign of something that is wrong. Okay, do you understand? So we have to watch what the market does Fridays into the close. The market were to crater today and take out the low of those 2 yellow days, we're probably getting closer to a risk monitor yellow than a risk monitor green. Okay? So what I'm doing with this information is raising cash in my portfolio, is getting off of margin in my most aggressive portfolio. I'm managing success. I'm managing risk. We have to get on the right side of probabilities when rewards worth risk. The way we do that is understanding that 8 out of 10 stocks follow the market. When the risk monitor goes green, that's the time to have max exposure. When we're a month away from risk monitor green, look, risk monitor green could last for 3, 4, 5, 6 months. I mean, I've seen it, right? So we're not out there selling our whole portfolio off. But we did raise 20 to 25% cash in the portfolio yesterday, recognizing where we are in the cycle and wanting to be able to take advantage of weakness instead of weakness taking advantage of us. So what I do at that moment, first thing I do to manage success, I get rid of the weakest laggers in my portfolio. Stocks, investments I've made that aren't working, that aren't going anywhere. Okay, so the first thing I did yesterday is remove Gush. I took a loss there. I removed EQT. I booked a profit there. Removed DTM. I booked a profit there. Removed KMI. I was about at break even on that trade. So I'm out of my energy positions, although I'm still long AMLP, which we've been long for like 2 years now. So I haven't sold AMLP yet. But I got to be honest with you, that's an ugly looking topping formation in the energy pipelines. Now, I'm not going to be early out of this thing because I'm collecting a fat dividend yield and I've owned it for 2 years, okay? But if this thing closes on a weekly level below that red line, I'm going to have to make a decision. Okay, I'm going to have to make a decision down there. I would argue, you know, if you bought recently up in here, you should probably already be out of AMLP. You should probably already be out of it. I could easily argue that. I think this line right here, okay, But because of how I own it and how long I've held it and the fat yield I'm collecting, I'm going to give it a little bit more room. Something's not right in energy. So the first thing I do when I want to raise cash is get rid of my lagging positions. Energy's gone. Then what I did, don't hate me. Don't hate me. Go do what you want to do. Okay. I'm telling you what I'm doing personally that fits my risk tolerance, my goals, my execution strategy. Okay. We've made a lot of money in precious metal stocks. I look at these 4 indexes and I know they're up again today and we could be in the midst of a short squeeze and I get all that stuff. Okay. But I booked my profit across the board in the mining stocks and I'm hoping to buy them back cheaper. I may not. I'm in the business of probabilities. There's always a probability. There's a chance. Maybe it's 20%. Maybe there's a 20% chance. That's probably it. I'm being generous. Okay. Maybe there's a 20% chance that these stocks just keep screaming higher and never come down again. 20% is, I'm being generous. Okay. Probably 10%. And it may happen, and I don't care. I manage my portfolio following probabilities and statistics. These 4 assets, gold, silver stocks, gold stocks, the ETFs, put in a reversal day yesterday. Silver recovered by the end of the day. That was pretty impressive. Could be a short squeeze. I don't know. I booked my profits. I'm long physical gold, which I'm not touching. I hope I get a shot at buying these things back cheaper. Yes, I sold all of those micro cap stocks. You know why? Because if the selling yesterday gets aggressive in the next couple of days for whatever reason, those stocks go bidless and I can't get out of them. And I have gains on all of them. So I just took my gains. That was great for me. Happy to make the money. Moving on. Hope to buy them back cheaper. That's what I'm doing with my portfolio. What I do when I want to raise cash is I go to what I added most recently and I sell it. Okay. So Cisco, I removed. I love the idea. Okay. I might be back in it by the end of the day today. But yesterday I wanted to raise some cash. So I go liquid on Cisco and Microsoft. Okay. I wanted to get myself to 20 to 25% cash. And selling all those things got me to that position. Where are we in the cycle of the market? We're at the stage now where we're managing success. So what we want to do is get rid of weakness, book some profits on swing trades where we're comfortable. We say, okay, now it's time for us to book a gain. Okay. Tighten up what we're adding to the portfolio. There's going to be a monster struggle inside of me, and I'm sharing it with you. Maybe you're going to experience it too. I'm going to see idea after idea after idea right now that I want to put in the portfolio. Honestly, at this stage in the cycle, I should put 0 into the portfolio. I can't promise you I'm going to do that, but it will be an internal struggle in me. We're more than a month out from a risk monitor green. Our most aggressive swing strategy that has gains of over 185% in 35 months is out of the market right now. When this strategy gets long again, I should be putting capital to work again. The strategy is wildly successful. It's right 90% of the time. It's insane. I mean, I say that in all humility. I didn't think it would be this accurate. When we started tracking it 2022, I said I've dialed it in to be about 70% accurate. 7 out of 10 trades will work. 9 out of 10 trades are working right now. I don't get it. I think I'm as surprised as you are. But we have this tool right here. When it goes long, there's a window to put capital to work where we're getting on the right side of probabilities. Obviously, we get long, it could go down. It's not a crystal ball, right? I keep saying to you, I don't think it's going to stay 90% accurate. I don't know why it's not that. I expect it to be 70%. So somewhere out there, we're going to put some trades on and we're going to get stopped out so that the probabilities go back to what I think they are. But I digress. That's not the point. Even at 70%, we're on the right side of probabilities if we put money to work when this strategy goes green. Right now, it's in cash. So to get on the right side of probabilities, step one is to, I've got all these ideas on the whiteboard. I want to own them all. When this strategy goes green, I can go into my whiteboard and say, okay, let's add a couple names to the investing side of my portfolio. I really should not add anything right now. I should be managing success, cutting out the dead wood, booking some profits in some of my favorite swing trades, raising stops, adjusting targets, raising stops. That's what I should be doing right now. I'm going to wrap up with my last thought of the day before the market opens, and that's going to be MP, okay? Just wanted to show you this chart on MP. It's a weekly chart of MP. We're seeing rare earth skyrocket. This was the original rare earth idea, and then we saw quad U's and METC skyrocket. This stock is making a classic high pennant on top of a weekly breakout. If this thing crosses 80, it's probably going to scream higher again. So it's at the top of my whiteboard. O'Neill would call this a little cup and handle. You see that little green cup and handle? Clearly 80 is the breakout. So I may be day trading that pennant. It's one of my favorite chart patterns. And if it pops and screams above 80, I would probably hold it overnight. Everybody, at the end of the day, please think for yourself and be the smart one.